In this video, we look at reasons why the stock market has rallied so much, but also what the drivers are behind that rally, because that'll help us to assess whether this is just a massive dead cat bounce, or whether this is a signal that we're going to see a very strong economic recovery coming out of this pandemic. Now, if you do want to keep abreast of market movements, but also the economic drivers behind them, why not sign up for our free weekly market roundup? There'll be a link in the description below and above me. So let's look at this rally in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. So is the rally that we've seen in equity markets just another dead cat bounce? Or is this equity markets pricing in a future cash flow recovery? Well, let's start by looking at what drives equity prices. Here's the S&P since 2004 in the top panel, and we can build a really simple model looking at just two factors. The first one is the size of the Fed balance sheet as a proportion of GDP. This really started to grow after the global financial crisis, and with each successive round of QE, it grew more. It's now approaching 40% of US GDP. And as we all know, earnings growth is the primary engine of price growth for the S&P 500. If we build a simple linear model of that growth based on those two factors, and then decompose it such that we can see how much of the price of the S&P is explained by corporate earnings in green and by the size of the Fed's balance sheet in red, you can see that the most important factor most of the time is of course earnings. But then during a crisis such as the global financial crisis, the very rapid increase in the size of the Fed's balance sheet acted to support markets. And that was more of a support during this period than corporate earnings, which fell dramatically. But because the size of the Fed's balance sheet remained large after the global financial crisis, that remained an important factor supporting equity prices, although it did tail off slightly as the Fed tapered the size of its balance sheet. But of course recently we've seen that massive rise in the size of the Fed's balance sheet, which is acting as a support for equity markets. And here we've got on the y-axis the price of the S&P 500 split into those components. So as we saw before, earnings is the most important factor, but the Fed's balance sheet kicks in at around 2009 and really hasn't gone away. But what you can see here in purple is the price of the S&P, which can't be explained by these two factors, corporate earnings and the Fed's balance sheet. Notice how that unexplained component of the price became sharply negative after the global financial crisis. So perhaps this reflects despair amongst investors having suffered such large losses in the equity market. And that suggests that they were paying too little for equity. But then in 2015 that turned around and despair turned into euphoria. And that's been pretty much in place since that transition in 2015. And it remains the case that the market remains in a euphoric state. Although an economic recession causes a great deal of suffering, from the point of view of equity markets, what matters much more is whether we have an earnings recession. Looking back to previous episodes when earnings fell by more than 40%, and here you can see earnings growth in the top panel and the return on the S&P 500 over a one-year period in the bottom panel, you can see that in this 1921-22 period, there was a very sharp fall in earnings. But this came at the end of a 3-year period of falling earnings and actually marked the turnaround. And what's interesting is that equity had already started to rally before earnings started to rise. And here's the fall in earnings during the Great Depression, which was very long-lived and very deep. But in fact, the fall in earnings was much larger in 1938, but it was relatively short-lived. And consequently, it didn't have such a large impact on equity prices. And notice again that earnings growth remained negative when equity markets already started to rally. And the lesson that we can learn here is that when there's a very long-lasting fall in earnings, such as this one which lasted 3 years, it creates a much bigger impact on equity. Whereas the fall in earnings in 2008 was fairly short-lived, but it was very large. So the impact on equity depends on two things: the depth of the fall in earnings, but also the period of time for which those earnings continue to fall, with the worst possible situation being a large fall in earnings which lasts a long period of time. If we look at the most recent data for the S&P since 2014, these are the quarterly, year-on-year changes in S&P earnings. What's interesting is that in 2019, there were 4 successive quarters when earnings growth was effectively zero. And in Q1 2020, we saw a fall of 14% as we started to see the effects of the lockdown in the US. It's looking like the fall in earnings in Q2 will be much larger, something like 45%. And broker forecasts are expecting the negative growth to continue for 2 more quarters. But then for the first 3 quarters of 2021, they're expecting year-on-year growth to turn positive, with a huge increase, admittedly off a very low base, in Q2 2021. So the key question for equity this time around is how long it's going to take for earnings growth to turn positive. And what the market's pricing in at the moment is a fairly rapid recovery. Now you might expect, because equity prices are rising, that fear would have subsided. But in fact, that doesn't seem to be the case. If we plot the VIX index, which is a gauge of volatility for the US equity market, which some people call the fear index, what you can see is that when equity markets fall, there's a very rapid spike in the VIX index. Now, when it's in its quiescent state, when there's no fear in the market, the typical value of VIX is around 15.7%. But during crises such as the global financial crisis, it increased above 80% for a short period of time. And that happened again in the March sell-off in 2020. But notice that it didn't fall back to those very low typical levels. It remains elevated. And if we zoom in on 2020, you can see that clearly this is well above 15.7%. In fact, for a lot of this summer, it's been above 30%, despite the fact that equities have rallied quite sharply. Now, the primary reason for that is that the cause of the uncertainty remains, and that's, of course, the pandemic. And if we look at other measures of uncertainty, such as the Economic Policy Uncertainty Index, which is based on mining US newspaper articles where the word uncertainty is associated with economic words, you can see that both that and VIX remain elevated. Another form of evidence that fear remains is that assets which are seen as safe havens continue to rally. We can look across asset classes by tracking the prices of the largest ETF funds. And here we're looking at the returns since February 2020, when the equity market was at its peak. Although equity has rallied, the asset classes which are performing best are the safe haven assets. So that's US Treasuries, and the ones with the longest duration are the ones which have rallied the most, but also gold, which is often seen as a hedge for fear, but also the investment-grade corporate bond ETF, LQD, but that may be because the Fed's been directly buying this ETF. And although riskier assets like emerging market funds and US equity have certainly rallied, they still haven't performed as well as those safe haven assets. So I certainly wouldn't characterize this as a confident recovery. If we were to invest $1 in each of those ETF funds on February the 19th, 2020, these lines track the value of that dollar over time. Now, if there were confidence returning to the markets, what I'd expect to see is that these safe haven assets would gradually lose their value over time as equity markets rally to take their place. But that certainly isn't the case yet. And many of these risky assets simply haven't recovered their original value, such as small caps and real estate investment trusts. If we look at the UK market in sterling terms, the picture is very similar, with long duration gilt funds providing the best returns, but also government bond funds from other regions. And the UK FTSE 250 is a worst performing fund, and it remains 21% below where it was on February the 19th. One sector seems to be fairly resilient in the crisis, and that's US tech. If we plot the value of the Nasdaq Composite Index divided by the S&P 500, where the Nasdaq is a tech-oriented index in the US, you can see that the last time it peaked was around 2000, at the very peak of the dot-com bubble, and US tech has simply been an outstanding performer over the last decade. And that's driven this ratio up again gradually over time, but that increase accelerated in 2020. Now, this part of the rally was probably driven by very strong corporate earnings for US tech stocks, whereas the rally at the end of the 1990s was not driven by earnings and was therefore unsustainable. Maybe tech has got a little ahead of itself, but at least this time it is underpinned by earnings. And this article from February before the sell-off showed that the vast majority of earnings growth in the S&P came from just 5 companies, with the acronym FAAMG for Facebook, Amazon, Apple, Microsoft, and Alphabet, which is Google. And despite the aggregate earnings for the S&P 500 in Q2 being atrocious, with an estimated fall of 45%, when you break it down by sector, utilities and information technology are the two which have been impacted the least. So it seems as if the fundamental reasons why tech has outperformed remain in place. And consequently, that signal about tech dominance may not necessarily be a warning sign. So as we've seen, the length of the earnings fall is what really matters. And that's why we have to monitor the shape of the recovery very carefully. You've probably seen people talking about a V-shaped recovery, and that recovery is the best possible case, because it consists of a short fall and then a very rapid rise back to trend growth. A much worse outcome would be a U-shaped recovery, where it takes much longer for growth to resume its trend. And an even worse outcome would be due to a second wave of the virus, and this is called a W-shaped recovery or a double dip recovery, because it lasts longer and it has a greater impact on long-term growth. A really important driver of growth is employment, and that's why we're always talking about US non-farm payrolls. It shows how many jobs there are in the US economy. When it's rising, that's a good sign because more people have jobs and they're then in a position to go out and spend, and that tends to boost corporate earnings. And during a recession, what we see is that employment falls very sharply, as happened in 2009. What's shocking about this recession was that in the space of a couple of months, we lost 10 years of jobs growth, as 22 million people became unemployed or were temporarily furloughed. And as the lockdowns have eased, we've seen a very rapid increase in employment, but we're still not back to the level we were at the peak just before the global financial crisis, which was 138 million employed people. Looking at the initial claims data, which is how many Americans are filing for unemployment benefits every week, that peaked at just under 7 million people every week at the end of March, and it fell very rapidly. However, what it looks like is that we have this very long and stubborn tail, and this suggests that we're not going to see a V-shaped recovery. It may take a very long time to reach levels of employment that we saw before the pandemic hit. If we strip out the number of people who are temporarily furloughed and look at the unemployment level for job losers who aren't on layoff, what's worrying is that that's rising very rapidly. And that may be as a result of the economic slowdown as healthy businesses lay off staff to cut costs, but also reflecting the fact that there's an increasing rate of bankruptcies, and that inevitably means that many people are being laid off. So you could hardly describe this as a confident rally, given that safe haven assets are rallying alongside risky assets like equity. And I think we're going to be exposed to a high risk of another sell-off, while the fundamental reason for the fear remains in the background, which is of course the pandemic. So if you enjoyed that video and you want to learn more about investing and you want to support us, then why not go to patreon.com. You can see the link above me here, and join us. It costs just $10 a month. You get to join us on Slack, which is the chat application you can see beside me here, where you can chat to me and other members of the community. Plus you get access to our live webinars where you can ask questions of me and I try to answer them as best I can. And here are the 2 latest contributions to our growing library of Patreon-only video content. And along with the video replay for that library of content, you also get notes so you can research things in more detail yourself. So if you do want to support us, you'll see the Patreon link over on the far side of the page. Just click on that and you can join us for $10 a month. And as always, thank you for listening.